This is episode 64. Is now the right time to invest in property? I'm going to go bold again and say yes, it's always the right time to invest in property. Last week, we talked about when was the wrong time to invest in property and looked in particular at the rising cost or value of houses and why that was important. And I said that you might be interested in that if you were going to buy property for investment purposes rather than as a home to live in, then what you might want to do is see that the value of the house that you bought on day one was worth the price that you were going to pay for it. Obviously, there's no emotion involved like there is with a home where you might be tempted to pay more. And the second reason is if you're investing in property at some point in the distant future, you might want to know that if you needed to sell the property or needed to change investment techniques, you could. So you want to know that generally you are buying in a market where the houses are going to increase in value, whether slowly or sharply, it doesn't matter. You just want that reassurance. Great. So if you followed last week's thinking, then hopefully I will have convinced you that now is the right time to invest in. Dear me, so sorry, guys. So if you followed last week's thinking, and then now is the right time to invest, are you convinced? And if you are convinced, then stop listening immediately and give me a call so I can help you on your journey. I'm only joking. Obviously, please do keep listening to the podcast. Maybe you still need to understand a bit more. And I hinted at the end of last week's podcast that I was going to talk to you about the cash flow, because I feel that the cash flow is a more important number to me than the capital gain. So let me help you understand a bit more. Property investment is not all about buying and selling for capital gain. If you buy property and constantly sell it, then what you're going to be doing is selling off your asset and not having any cash flow. You might, if you're lucky and you get your numbers right, be taking out chunks of money. But if you then don't do something with that chunk of money, that's like killing the goose, and then you're only left with the eggs. And unless you grow one of those eggs into another goose, there's only so many eggs you're going to have. It's all over. So for most investors, property investing is like a second business. It's designed to generate, first of all, a better rate of return on the money that they have, but also to provide additional financial security that comes with a second source of regular income, like rental income. So before we get into how you can invest in property and what techniques you might choose to use, you might still want to understand a bit more about predicting the market. And while I have explained that property prices rise and now is the best time to invest, how do you know specifically what this would look for you? So I was talking to a client yesterday and they turned around and asked the question, should we wait till next year? And I can tell you, if I had £1 for every time I heard that question or a variation on it, I would have been a millionaire many times over. Sometimes this sort of question is driven from a general lack of understanding of the supply and the demand that we talked about last week. But more often, it's about understanding, is this a good use of my money? And so I'm going to introduce the concept of ROI, return on investment. And that's what we're going to look at as a way to help you answer the question, should I be investing now or should I wait till next year? So I mentioned to you that the Halifax have told us already that house prices have tripled. And I also said to you that cash flow is sanity, because property is a long-term investment. And if you can't afford to maintain the property to a standard where it is worth the value that the rest of the houses on the street are, or you can't ride the waves of changes in interest rate, then you're going to lose the property. So we need to know that the cash flow is significant. Let me just pop back for one little moment and say let me remind you about house prices and how dramatically they've risen over the last 3 decades. Yes, we've heard about this tripling, but I don't think that really shows you. And so what again I've done is I've grabbed a graph, and this time it's from the FT, the Financial Times, and you can see how dramatic that growth line is. So pop over to the show notes and have a look at those. While you're going to spend money to buy property, it's actually how that money is repaid to you or what interest it gives you that matters. So let's look at these 2 points. First, when you invest in property, you look at your savings as being used to create a monthly payout, which would be the same as if you left that money in a building society and you would earn interest from that savings account, but that interest is usually paid out annually. Property, because we charge the tenants rent on a monthly basis, means that that interest is paid out to you on a monthly basis. So if you're interested in cash flow and the return that you're going to get on that investment that you've made, that's quite easy to calculate. If you take all the money that you are going to earn from the property, so your net rental profit for the year, and you divide that by the actual amount of money you needed to pay out to buy the property in the first place. So that's the deposit, the stamp duty, the solicitors and surveys, and I personally include insurance and gas certificates and repairs and everything else in there. So you've got a lump sum that you're going to have to pay out to buy this property, and then over the year you're going to get an amount of money back. That is how you calculate ROI. It's annual net profit over cash invested. And that is, if you think about it again in building society terms or savings accounts terms, that's the same. I'm going to put this amount of money in a savings account and I'm going to receive this amount of money back. That's how you compare various types of investments. It means that you can level out your investment comparisons. Do your shares make as much money as your building society savings, as much as your property savings? And this is more accurate than looking at a gross value like yield. So a lot of people, when they talk about property, they will talk about the yield. The yield is this, the yield is that. And yield is looking at the gross numbers, not the net numbers. But this for me doesn't work, because 2 houses could be sold for the same price, but one might require considerable renovations and the other may not, may be able to be rented out immediately. So yield would not consider the costs of repair, and also doesn't consider all of the additional money that goes into buying a house. It's not just the deposit, it is the solicitors, the stamp duty, and everything else. So I prefer to talk in net terms. Okay, so you've understood that there is a formula, and that will give you the sense of the equivalent interest that you can earn and enable you to compare your different investment strategies. You might want to invest in property and have the rental profit pay back your initial lump sum. And the reason that you're doing that is because, one, you don't need the additional income at the moment. You're working and you're quite happy not to use that additional income in your daily life. And what you want to do is get that rental income to store up, in a sense, rebuild your original investment pot so that you can buy again. And that's perfectly fine. That doesn't require you to remortgage the property. That is using the cash flow to rebuild your pot and go again. And if that is your strategy, that's a great way to grow a portfolio. It can provide for your future needs because you can use the cash flow now to grow the portfolio. And then 10 years' time, when you decide you want to work less or you want to retire early, you know that those properties are now there and you can start using that cash flow. Fine. So what's ROI got to do with property prices and whether now is the right time to invest? Well, if the cost of property is gradually increasing and the cost of rent is increasing, and again, I've popped a graph in the show notes for you that, again, look at the upward curve of prices. How is this relevant? How is it relevant if the cost to buy is increasing? Then it's costing you more. The longer you wait, it's going to cost you more to buy this property. And even if the rent goes up, how do you know that the profit you are earning is also going to increase? Because how do we know that the rent increase is sufficient, almost like as a ratio, to cover the extra 10,000 or 20,000 that you have to pay on the house? That's why ROI works. That's why it's so easy to work out. Hang on a second. So last year the house prices were this, and this year the house prices are this. This is the return that I'm getting. I can still see that I am happy with the level of return. I'm going to give you some examples in a minute, but what I just want to do is just tap into that for 1 second. If we use ROI as a way to compare different investment options that you have, if putting your money in an easy access savings account with a bank or a building society might get you, let's say, the number 2%. If we put some restrictions on that money, which means that you can't pull it out for, say, 5 years or 3 years, 5 years, whatever number, some savings accounts say, I'll give you a higher rate of interest, but you can't make any withdrawals in this period. Let's say you could get 4%. If you could put that money with the aid of a mortgage, remember there's always a mortgage to be paid in this, unless you buy outright for cash. With the aid of a mortgage, you put that money into a property and you leave it there for 5 years. You need to know, because of the risk involved with buying a house, because you're taking on debt as opposed to just piling in your savings, you're leveraging your savings, that interest rate is going to be higher than 4%. Because if it's not higher than 4%, if it is just 4%, or even if it was 5%, why not just put it in long-term savings where there's no risk and you can just do nothing? There's no checking that your rent's coming on a monthly basis, and there are no refurb or repair costs with a savings account. Okay, so that's easy. But what if the rate that you could get from your house that you're going to invest in from your rental income was 7%, 8%, 9%, 10%? That all depends where we are in the market. Then maybe you would consider that checking that your rent has come in just once a month, so looking at your bank account once a month and taking the occasional email from your letting agent to say this repair is needed, is worth an extra 3% on your money, or 4% or 5% on your money. That's why ROI is interesting. Now, the other thing is that although we can see house prices rise and rents rise, over the years, I've experienced what I would call micro pockets where understanding how the market moves and works is really important. And I just want to use these as a little warning on, I suppose it's the overexcitement that can come with property, or the potential to get rich quick that can come along. And that's why I started with supply and demand last week as an example. So if the demand for houses means that a lot of people are wanting to buy either residential or for investment purposes, the house prices will rise. If the demand for that certain type of property becomes a target for investors, then there very specifically needs to be a demand that matches it in terms of rental and tenants wanting to be there, and also the rent increases. Because if you think about it, if the ROI doesn't stack up, if the rents haven't accrued at the same level, it might not be the best location to invest. It doesn't mean to say that you still don't invest in property. Maybe you just don't invest in that street, that area, that postcode, that town. You might be better off looking somewhere else. And let me give you that example. In about 2009, work began on Crossrail, which is a project to put in a brand new east-west facing railway line that would run from outside the west of London through London and then outside the east of London. The purpose, of course, was to create speedier access for people into central London where jobs were, where housing was very expensive in central London. The people who worked in London had to live further and further away from their jobs. So putting in a line that connected all of this made sense, faster commuter routes. And one of the places way out in the west was Reading. And so what was going to happen is that while people could at the moment get a train that would take them into Reading, this new train line was going to be speedy and cut maybe 20 minutes or something off of their journey, but also take them further quicker. Great. So investors, and probably, let's be honest, estate agents, spotted an opportunity. At the time, I attended and often spoke at a regular, popular London property event, and it was run by a local estate agent. During the period roughly 2012 to 2016, they promoted HMOs, houses of multiple occupancy, to their audience. So shared accommodation for the theoretically younger people that were going to be working in London to come out and have a room in a shared house as an affordable way for them to live, but also tying in with this quick rail transport link that was being put in. In the initial few years, a large Victorian property could be bought for approximately 250 to 300,000 and converted into a 4-bed, maybe if you were lucky, a 5-bed HMO. Within 5 years, property prices were hitting 400,000 and beyond. Okay, so I did say that property prices increase. You don't usually see that degree of interest. And when you see prices increasing that rapidly, you need to look at what local factors are affecting the prices. And we could see that there was a certain property style that lent itself to being converted into an HMO, and those were the properties that were being bought up hungrily by investors and were being promoted and stalked, if you like, by the estate agents so that they could sell them. So what about rents? Because that's actually how an investor makes money. Well, initially the rents were great, but then all of a sudden there was an oversupply of rooms. And the estate agent both sold the properties, but also offered a rental service. So they would manage the properties for the investors that they brought into the market. And that's great for the investor, because then they're buying and having the property rented out. The estate agent was not only an expert in selling houses of the right style to be converted into HMOs, they were also expert in renting these properties out. They had the whole marketing machine. All of a sudden, their fee for letting the properties rose from 14%, because it's always higher on an HMO, to 24%. Now, thinking about supply and demand, why did they increase their price so dramatically? Because they needed to put people off. They needed some of the landlords that were with them to move to other people because they could not afford the 24% or did not want to pay the 24% fee. And that way, the letting agent side of this estate agent would reduce the number of properties that they handled. Why? Because it was finding them harder to fill. And so their clients, their landlords, weren't happy because they weren't making the return. Now, this also happened to me in a different way in a property that I chose to invest in. We started buying properties, again, maybe 2014. We were buying properties at about 100,000 with room rates at about £120 per person per week. Within 3 years, a new wealthy investor had found the area, had literally £1 million to invest in this area. They started buying up the properties. The property prices rose because they weren't negotiating as hard. And actually, because what they wanted was the stock, the property stock, they were prepared to outbid. So where we had been following a strategy of it's on the market for 100,000, we'd offer 90 and get it for 95. They were coming in and offering 105 because they knew they wanted that property because it was of the right footprint that they wanted for their conversions. And so they were driving the prices. And this is an example of where the demand for houses was strong, the supply of houses was strong, but then there were so many rooms available. So while house prices were rising, there were so many rooms available, there wasn't the demand for renting. And so the room rates dropped from £120 per person per week to 90. So the rents were now 75% of the initial rate, and the house prices were 140% of the original purchase prices. The ROI no longer worked. It wasn't a good area to be buying in. So we stopped. We moved to another area, but 10 or so years later, we've come back round because the prices have stabilized in terms of house prices. But what we can also see now is that another factor, which is a license put over the top of the area that restricts the number of houses of multiple occupancy that can be in there, it's called Article 4, has constrained the number of rooms available. And so the rates in the rooms, the rents are starting to increase again. So what's this got to do with is now the right time to buy? Because in the truest sense, only a generalized prediction, but property prices will always rise. Therefore, now is the best time to invest. But with that generalization, we can also understand that we need to understand it at a more micro level in the local area that you're thinking of buying, the street, the postcode, the town. It's not just about property prices going up, because the example I gave, the property prices went from 100 to 140,000. But there wasn't the demand there for the rent. And that's why you need to understand ROI. You need to be looking at how much money your money is going to be making, even though the house that you buy might increase in value. If it's not rented out, like the Reading example, or it's rented out for considerably less, like my example, then you're not going to make the return that you were looking for. There is always going to be a need for private renting for people by us, the sort of private landlords. Some people don't want to buy their properties. Some people can't afford to buy their properties. And so that demand will remain strong. Understanding ROI and the profit that you can make from investing in property from the rental returns rather than the capital is so important to you. And again, just making a generalized statement, now is the best time to buy, and the only better time to have bought would have been last year. I'm slightly joking there, but actually, if you ever do find a time machine and you can go back and invest in property, why wouldn't you? Because the prices would have been cheap. And that's going to tie in with one of the podcasts that I'll do in a couple of weeks' time, which is about never selling a cheap asset. The house that you buy today, tomorrow, next week will always be cheaper than the house that you buy next year, looking at like for like. So I know it's a bit more maths heavy this time round, but I hope I've been able to put a little bit of whoosh into your understanding about cash flow again. So it's great to be able to understand that property prices are always going to rise, but actually it's looking at the supply and the demand, if you like, for the renting and the value of the rent that you can get, because that's what determines the return on your investment. Yes, you want to buy well, but if you don't rent well, then it's not a profitable investment, is it? Okay, so I wish you all the best. Thank you very much for listening to A Wealthy Life. My name's been blinking heck. I don't know where to go back to now. So I just want to thank you very much for listening. My name is Vicky Wishay. This is a Wealthy Life podcast, and I will speak to you again next week. Very best wishes.